Good evening to all the participants. I welcome you on behalf of Madras Tax Bar, and I wish all of you a very happy Friendships Day. Today, we have Ms. Sahana who will be taking the session today, and uh, the session will go on after she completes the presentation. We'll have the question answer round where we will uh, where you can raise your hands or you can send in your messages or your queries in the chat box if you at the end of the round. So hope we have a wonderful session today, and thanks once again to all for joining us. Thank you. Sahana, over to you.
Prithvi, I'll just share my screen.
Yes, I have given the access.
Is it visible, Prithvi?
Yes,
Okay.
it's clear.
Good evening to one and all. Thank you all for joining in today and on a Sunday evening. I'm Sahana Rajkumar. I'm a lawyer and I work with Lakshmi Kumaran and Sridharan attorneys. Today, I will be presenting on the topic input tax credit eligibility on goods which have been lost, stolen, destroyed, written off, and disposed of as gifts or free samples. In essence, the topic for today will revolve around Section 17(5)(h) of the CGST Act. Now, this particular topic gains even more significance in today's day, especially in light of the ongoing coronavirus pandemic, because businesses across the country are facing several issues in terms of their assets and goods being destroyed or lost or stolen on account of the various lockdowns that have been imposed upon us. So in light of this particular topic also gains more significance. I will be taking you through Section 17(5)(h) of the CGST Act in specific, and the various nuances and interpretations that can flow out of this specific provision and its applicability to day-to-day business scenarios. Without any further delay, I will go directly into the presentation. Before going into what Section 17(5)(h) of the CGST Act is, it is relevant that some courtesy be placed on the concept of input tax credit. Now, as we all know, input tax credit as a concept is nothing but a benefit that is made available to recipients who would procure various inputs, input services, and capital goods in the course of their business. And this benefit would be available with these recipients as a set-off that they can utilize against their output liabilities. Now, the law provides that this benefit of credit will be available only when the procurements which are made are used in the course of furtherance of business. This is contained in Section 16(1) of the CGST Act. This particular benefit is also subject to certain restrictions and conditions. My topic today will revolve around a specific restriction which is contained in Section 17(5)(h) of the CGST Act. Now, before I go into the concept of Section 17(5)(h), one thing that needs to be kept in mind while considering this particular topic is that in every act of creation or an act of manufacture, there will always be a certain inevitable destruction that may occur. Like they say that in every act of creation, there is an inevitable act of destruction that occurs. And my topic will revolve around the implications of GST on that particular acts of destruction. But before I go into that, I've just taken up an illustration. And this considers a specific act of creation of manufacturing a new motor vehicle. What needs to be kept in mind here is that in trying to achieve the ultimate objective of having to manufacture a motor vehicle, there are several chains containing different stakeholders who perform certain specific functions in a sequential manner. And through these functions that is performed by them, it will ultimately result in the production of a motor vehicle. Now, take in this case, the first supplier, he produces iron ingots from iron ore, which is then supplied to supplier 2. The second supplier will manufacture steel in roll form. The third supplier will cut and slit the steel which is procured from the second supplier in roll form into sheets. which is then made available to the fourth supplier. The fourth supplier will then use these steel sheets to manufacture automobile components. These components will then be supplied to the fifth supplier, who will ultimately use it in manufacturing the motor vehicle. Now, this is a sample chain of supplies that result in the production of a motor vehicle. And in each such stage, the concept of credit is that in all the procurements that is made by every supplier on every stage, credit will be available to these suppliers to offset it against their output liabilities. And this ensures the seamless flow of input tax credit, which is the famous tagline that is always associated with the concept of GST. And the ultimate aim, of course, has always been to mitigate tax on tax, that is the cascading effect of taxes. But taking into account this specific chain of supplies, assuming in any one of these stages, say for instance, where the fourth supplier is supplying automobile components to the motor vehicle manufacturer, assuming there is some amount of waste or some residue which arises in the course of his manufacturing process, a question that comes up is, will credit still be available as we had envisaged, where there'll be a seamless flow, or are there any restrictions that the law places? I put forth this illustration as of now here because I would be taking this up in the course of my presentation. But as of now, I will stop here with this presentation and I will go into the actual restriction, which is laid down in section 17(5)(h) of the CGST Act. Section 17(5)(h) of the CGST Act is a non-obstante clause. It provides that notwithstanding anything contained in subsection 1 of section 16, input tax credit shall not be available in respect of goods lost, stolen, destroyed, written off, or disposed of by way of gifts or free samples. Now, there are three different aspects to this specific provision. First is that this clause is contained within a non-obstante clause, which means that section 16(1), which we had discussed earlier, although it provides that input tax credit can be availed so long as the goods which are procured are used in the course of business, since this clause is contained in a non-obstante clause, even irrespective of whether the goods are used in the course of furtherance of business or not, if the goods are lost, stolen, destroyed, or written off, or disposed of by way of gift or free samples, this provision states that input tax credit will not be available. The second point that needs to be noted here is that this particular provision is relevant only for goods. It does not apply to services. And the last aspect that needs some deliberation is, what do we understand by lost, stolen, destroyed, written off, and disposed of? I will deal with these three aspects as I progress with my presentation, but I will begin with what do we understand by the meanings of the terms lost, stolen, destroyed, written off, and disposed of. None of these terms are defined under the GST Act. So therefore, I draw inference from certain dictionary meanings, which I have borrowed from Oxford Dictionary and the Merriam-Webster's Dictionary. The term lost has been defined to mean unable to be found. The term steal or stolen means to take another's property without permission or legal right and without intending to return it. Oxford Dictionary defines destroy as to end the existence of something by damaging or attacking it. Written off is defined in the Oxford Dictionary as a cancellation from an account of a bad debt or worthless asset. And dispose of is defined to mean the transfer to the control of another or to get rid of. Now, a common thread that seems to run across all of these definitions is that on the occurrence of these specific events, the goods in question would no longer be available for a person to use it in his business. With this prima facie understanding, I will go into the specific issue that I will be taking up now. This is the same issue as the illustration that I had put forth. In the illustration, assuming there is a scenario where there is some steel residue which arises out of the activity of manufacturing automobile components. So the question that comes up is, in such scenarios, if there is any waste generated at any stage of manufacture, will the result of this particular provision, section 17(5)(h), mean that there will be a necessity on the person who has availed that credit to reverse it? Now, going by just a understanding of the dictionary meanings of these terms, on a literal understanding of what do we mean by a term, by a goods which has been destroyed or which has been lost, one may say that if there is any steel residue which arises out of the input which is procured by supplier 4 in this case. That is the steel sheets which have been procured, and there is some steel residue which is nothing but a waste which may be sold by this person on payment of tax. The question that comes up is there a requirement to reverse? Going literally only by the dictionary meanings, one may arrive at the conclusion that yes, there would be a requirement to reverse the credit. And the result of this is that at that particular stage, where supplier floor 4 would be, where credit would be blocked for this specific person, the result would be that supplier 4 would build that cost into the price of his components, which will ultimately again lead to the concept of cascading effect of taxes. But with this, I would like to break down my presentation into 3 parts. First, I will deal with what do we mean by goods lost, stolen, and destroyed. Secondly, on the concept of written off. And lastly, on what do we mean by goods which has been disposed of by way of gift of free sample. Now, although I had placed a certain interpretation on section 17(5)(h), a prima facie interpretation only bases the dictionary meanings, in my opinion, that there are 2 schools of thought that can arise while interpreting section 17(5)(h). One is the literal and strict interpretation, as I put forth, where the law should be understood just as it stands, without adding or deleting any words or without trying to infer any supposed intention. The other school of thought is the thought of contextualism. This particular concept is basically where the law should be read in the context in which it has been drafted. This we may relate to a well-known canon of construction, which is Nocitera Society. The particular terms which I'm considering at this part of my presentation, which is goods lost, stolen, and destroyed. When we consider the meanings of the terms lost and stolen, one may seem to, we may think that it will only encompass within its scope events that a person will not be able to foresee, or a person will not be able to foreknow, and no rational person would want their goods to be lost or stolen. So therefore, one may draw an inference that when the legislature used the term lost and stolen, they had in mind only unintended eventualities such as flood, fire, or even the COVID-19 pandemic. But the term destroyed is of much broader connotation. Any particular product that loses its form or is rendered useless can be said to be destroyed by the dictionary meaning of the term. But the question that arises is, should destroyed be understood in that fashion, or applying the test of contextualism, can it be understood in the same way in which the terms lost and stolen are understood? Because destroyed is accompanied alongside these specific terms. So applying the rule of Nocitera Society, can one say that the term destroyed in section 17(5)(h) will include within its scope only those events where a person may not be able to foresee or foreknow, or an unintended eventuality that a person would not expect. Like applying this to a particular scenario, one can take up an example where a manufacturer may be aware that in his manufacturing process, there is no doubt that there will be certain waste or residue that will arise, or certain goods may be damaged. For instance, a biscuit manufacturer will always know that in manufacturing biscuits, there would be certain biscuits which would be lost or which would be damaged. Similarly, in the case of a glass bottle manufacturer. In these scenarios, applying the test of contextualism, one view, in my opinion, which is possible, is that we can say that these goods are not destroyed in the process of manufacturing, because the manufacturers were aware that these are normal losses that will necessarily occur in the course of manufacture. So therefore, they will not fall within the scope of destroyed, applying the test of the reasoning which we would apply while reading this provision along with the terms lost and stolen. A very similar logic may also be extended to invisible losses that also occur in the course of manufacturing. The question that arises here is, can it be said that these goods have been consumed, or are these goods destroyed? Because these are losses that will necessarily occur in the course of manufacture, and there is nothing that a person would be able to do about that. In fact, this particular very same question came up before the Honorable Madras High Court in the case of GBR Metals. This was in the context of the TN VAT Act. There is a very similar provision under the TN VAT Act, which is section 19.3 of the TN VAT Act, This particular provision provides that input tax credit would not be available in respect of goods which have been destroyed in an intermediate stage of manufacture. So the question that came up before the Honorable Madras High Court in the case of GBR Metals was, what is the scope of this particular provision? And the court observed that only those goods which are withdrawn from an intermediate stage of manufacture and they are completely rendered redundant or used or useless or are completely destroyed, only such goods can be said to be actually destroyed in an intermediate stage of manufacture. But goods which will anyway form part of a manufacturing process and they will result in certain loss or certain residue, those inputs can only be said to be consumed in the process of manufacture. They term that loss as an invisible loss, and they say that these are only goods which are consumed in the process of manufacture. They cannot be said to be goods destroyed in an intermediate stage of manufacture, and therefore the Honorable Madras High Court held that there is no requirement to reverse the credit. Very same logic, a very similar logic was also put forth by the Honorable Supreme Court in the decision of Swadeshi Politics, the landmark decision from the excise regime. In this case also, certain input, a chemical, ethylene glycol, was purchased by this manufacturer for the purpose of manufacturing polyester fibers. And in the process of manufacturing these particular fibers, there is certain amount of residue or waste, which they call methanol, which arises out of this particular process. In this case, the department sought to deny the set-off credit in respect of those inputs, ethylene glycol, for the reason that a certain portion of those inputs would be contained in methanol, which is the waste, which is a non-excisable product. And although polyester fiber is an excisable good, they sought to deny the credit. And in this case, the Honorable Supreme Court recognized that credit need not be reversed when the goods are consumed in the process of manufacture. And here they held that this ethylene glycol, which was used in manufacturing polyester fibers, although there would be some amount of waste or residue that necessarily arises, and there would be some amount which would be contained in that waste, that is methanol in this case, no doubt it cannot be said that these inputs, that is the ethylene glycol, has not been used in manufacturing the polyester fiber. They said that it is consumed in the process and therefore it is not destroyed, it is only consumed, and thus the credit should be granted to this particular assessee. In my opinion, this logic can be extended also to Section 17(5)(h) of the CGST Act while interpreting the specific term destroyed. One can take the view that applying the test of contextualism and understanding this term in the context in which it is contained, that is in the terms lost and stolen, a person may be required to reverse credit under Section 17(5)(h) only if certain goods are lost, which is completely as a result of unintended eventualities, not those goods which are a normal loss that will necessarily occur in the course of manufacture. In those cases, it can be said that the goods are not destroyed, but the goods are actually consumed in the course of manufacture. This then brings me to the other school of thought, that is the strict interpretation or the literal interpretation. Now, by a general dictionary meaning of the term destroyed, one may understand it as any product whose form or structure is ruined will qualify as a good that is destroyed. So therefore, one may take the view that a residue or a waste which arises out of a manufacturing process can be said to be goods which have been destroyed. That is, the input that has been used in manufacturing the product has been destroyed to the extent it has resulted in a waste or residue. So therefore, going merely by the strict interpretation, one would have to ignore the usage to which these wastes may be put. And one will always have to keep in mind that in businesses as on date, these wastes also have certain usages. Some manufacturers may not find any use for it. However, other manufacturers may infuse these wastes in further production processes, or the waste may be sold for a price to maximize their profits even further. But ignoring all of these commercial realities, going only by the strict interpretation, the alternate view which is plausible is that this waste that has risen has resulted in goods which has been destroyed, and therefore credit in respect of those goods would have to mandatorily be reversed. But in my humble opinion, such a literal reading would defeat the intent of the law, and it would also lead to absurd consequences, like in the case that we had considered the automobile component manufacturer, where even though there would be some amount of residue that arises out of him manufacturing goods, manufacturing automobile components, but applying this literal leading as a result of this residue having been generated, there would be a necessity for the credit to be reversed. Now, keeping these two tests in mind, the two hypotheses, that is the test of strict interpretation and the test of contextualism, we will apply it to certain scenarios. The first scenario is, of course, the which I had just considered on manufacturing loss or process loss. Here, of course, a view can be taken that if they are usual losses that a person will foresee, then these losses are, they cannot be said to be goods which have been destroyed in the course of their business. It is merely goods which have been consumed in the process of manufacturing. Similarly, in the case of goods which have been put to use in quality testing or research and they are destroyed in that process, a question can come up as to, is there a requirement for reversal of credit when these goods have been destroyed during testing? Testing and research, as we understand it now, is R&D is such an important and vital part of manufacturing. So a person may not be able to even manufacture products without putting their goods through R&D testing and research. So one can take the view, applying contextualism, that a person knows quite well that when they put it through testing for the purpose of manufacturing, the goods will be destroyed. So therefore, that cannot be said to be goods which has been destroyed in the course of testing or manufacture. They are merely goods which are consumed in that process. However, applying a strict interpretation here, one can also take the view that these goods have in fact been destroyed because they are no longer available in the business for use, and credit would have to be reversed. The third scenario concerns goods which are lost in stock verification or transit. This is, according to me, an open and shut case where this is squarely fall within the scope of section 17(5)(h) of the CGST Act, because these goods are lost in transit or stock verification are things that a person may not be able to, will not foresee. So therefore, these situations are squarely covered by section 17(5)(h). The next situation is loss of quantity of goods due to atmospheric changes. This is what we also dealt with earlier as invisible losses. So there may be certain products, certain chemicals, etc., which are used in, say, manufacturing of fertilizer or certain other products where, because of atmospheric changes, the quantum of that product may be automatically reduced when they are put through the process of manufacture. So a question may arise as to whether credit in respect of those goods whose quantum has reduced, has been lost, and therefore credit should be reversed, is a question that arises. Here, again, both views are possible. One may say that this is an invisible loss, there's nothing a person can do about it, and the person is quite aware that these losses would occur in the course of manufacture. So therefore, applying the test of contextualism, there is no requirement to reverse the credit. This brings me then to the last scenario, which is scrap sale of substandard goods. In this particular scenario, when, say, on account of the COVID-19 pandemic, some goods have become substandard, a manufacturer may sell these goods for a lesser value. So a question may arise as to whether in these scenarios also credit is required to be reversed. In my opinion, here, since tax would be paid on the output supply, and these goods would, even though they are no longer usable in this particular business, since they have been put to use in making that taxable supply, it cannot be said that these goods are lost, stolen, or destroyed. They cannot be said to be destroyed because they have been actually put to use in the form of a sale. It is a subject matter of a sale on which tax is paid on the output end, and therefore they will not fall within the scope of section 17(5)(h) of the CGST Act, is a stand that can be taken. With this, I will proceed into the next concept, which is contained within section 17(5)(h) of the CGST Act. This is the concept of write-off. Here, there are three different concepts which will have to be kept in mind. There is write-off, there is the partial write-off, or what we understand as writing down of an asset, and there is the concept of creating a provision to write off. Now, it is important to understand what each of these particular topics signify. For this, again, there are no definitions under the GST Act. So therefore, I have placed reliance on dictionary definitions. The term write-off has been explained in Black's Law Dictionary to mean to remove an asset from books, especially as a loss or expense. Oxford Dictionary defines it as a cancellation from an account of a bad debt or worthless asset. Merriam-Webster's dictionaries defines it as to eliminate an asset from the books or to enter it as a loss or expense. So therefore, it's clear from these dictionary definitions of the term write-off that an asset which is completely removed from books, or which is a complete bad debt, or it's a complete worthless asset, those assets will be fully written off from the books. Now, this concept will also have to be understood along with the concept of writing down. The writing down has been explained in Merriam's dictionary as an accounting term which is used to describe a reduction in the book value of an asset due to economic or fundamental changes in the asset. And Collins' dictionary also defines it as an act of decreasing the book value of an asset. So therefore, this particular concept is nothing but merely a reduction of the value of an asset. But unlike write-off, it will not involve removal of the asset entirely from the books. Apart from these two concepts of write-off and write down is what we colloquially understand also as partial writing off. There is also the concept of creating a provision to write off. Now, creating a provision to write off is an accounting practice where certain bad debts which may be foreseen, although it is uncertain, but when there is an expense which is foreseen, a provision is created in the books of accounts, which is nothing but a provision to write off. Under the Income Tax Act, Section 36 of the Income Tax Act, it allows for deduction towards bad debts which are written off from the income of the assessee. But what is relevant here is the explanation to Section 31(1). This particular provision states that for the purposes of this clause, any bad debt or part thereof written off as irrevocable in the accounts of an assessee shall not include any provision for bad and doubtful debt made in the accounts of the assessee. Now, this particular provision clearly creates a distinction between the concept of completely writing off an asset and merely creating a provision to write off. And this provision also states that writing off an asset, which would be allowed as deduction under the Income Tax Act, will not include within its scope a mere provision that has been created to write off. So therefore, one may draw an inference that the concept of writing off will not include within its scope a provision to write off. But what needs to be kept in mind is Section 17(5)(h) of the CGST Act. It only uses the term written off. It does not qualify it as whether it would cover a scenario of partial write-off and also whether it will qualify a scenario of merely a provision to write off. So therefore, this particular question needs to be answered as to whether written off will include within its scope both partial write-off and a provision to write off. Here again, I apply the very first hypothesis that I put forth, which is the test of contextualism. Applying this test, one may take a stand that because the term written off is found in association with the words lost, stolen, destroyed, and disposed of, which signify by their general understanding only those events as a result of which there is a permanent loss of the goods, and these goods will no longer be available in a business to be used. So therefore, applying that logic, one may say that when the term written off has been used, it will only cover within its scope those eventualities where the asset is completely removed from the books or is written off as a bad asset. So therefore, one may conclude that where there is mere writing down of the asset, where there's a partial write-off of the asset, or there is a mere provision to write off of the asset, those will not be covered within the scope of written off, and ITC need not be reversed in respect of those goods who have only been partially written off or in respect of which a provision to write off has been created. And in fact, this particular inference may also be drawn from some jurisprudence which is developed under the erstwhile central excise regime. The SENVAT credit rules 2004 provided for a specific rule, Rule 35B, which also contained a similar provision. It stated that if inputs or capital goods were written off fully or partially, or where any provision to write off fully or partially has been made in the books, then the assessee would be required to pay an amount equal to the SENVAT credit availed. It's important to note here that this provision is applicable only for inputs or capital goods before they have been put to use. So therefore, before being put to use, if certain goods were either fully written off or partially or only a provision to write off is made, still Rule 35B of the SENVAT credit rules provided that send-back credit would have to be reversed. The proviso to this particular rule is also relevant. The proviso states that if the said input or capital goods is subsequently used in the manufacture of final product or provision of output service, then the manufacturer or output service provider, as the case may be, shall be entitled to take the credit of the amount equivalent to the send-back credit paid earlier, subject to other provisions of these rules. So the proviso states that if these goods, even though they have been written off partially, fully, etc., so long as they are used in providing an output supply of, they are used in manufacturing a product or in providing an output service, then the credit can be taken back. Now, it is relevant to note that until March 2011, Rule 35B did not include within its scope scenarios where there was a partial write-off. It only covered scenarios where there was a full write-off which had occurred. Only in 2011, there was an amendment which was brought in, which introduced this particular concept. So this led to several new jurisprudences arising, because the department began issuing show cause notices demanding reversal of credits in respect of those goods which had been partially written off prior to 2011. I will take up two such cases. Both are very similar. One in the decision of Kirloskar Ferris Industries, it's a tribunal decision, and also Sangvi Engineering, also a tribunal decision, both assessed at Bangalore. In both these cases, the manufacturers had partially written off certain goods prior to 2011, in the year 2009 and 10 in this case. And there was a show cause notice issued demanding reversal of send-back credit because of the introduction of the amendment to Rule 35B. Here, in both cases, the tribunal recognized that the obligation to reverse credit in case of partial write-off came into existence only after 1st of March 2011. And this amendment is not retrospective, it is only prospective. So therefore, if the partial write-off has occurred prior to this amendment, there is no requirement now to reverse the credit. From these judgments, an inference that can be drawn is, applying the test of contextualism, of course, is that in the concept of written off, the partial write-off, the concepts of partial write-off and provision to write-off will not be covered because they have not been specifically mentioned. And similar to what has been an inference that can be drawn from these decisions also is, until such time when they were specifically brought in, what was mentioned in Rule 35B was only a full write-off of an asset. So therefore, an inference can be drawn that when written off is used, the term written off is used in Section 17(5)(h) of the CGST Act, it will cover within its scope only actual full write-off of an asset. It will not cover situations of a partial write-off or a provision to write-off. However, applying another alternate approach, this is a purposive approach of interpretation. Here, one may also argue that it is the intent of the legislation that needs to be taken into account. And how do we determine this intent? We take into account various factors, such as the history surrounding the birth of the GST statute, its object, purpose, etc. And considering that the erstwhile central excise regime, the send-back credit rules, specifically covered within its scope partial write-off and even a provision to write-off, one may infer that even when the legislature used the term written off in Section 17(5)(h) of the CGST Act, it intended to cover not just a write-off, a full write-off, it also intended to cover within its scope partial write-off and a provision to write-off. So therefore, we'll have to read all of these concepts into written off. This is the alternate approach that can be drawn. But there are some peculiar questions that will arise on it, when this particular provision is applied in business. Let us take a scenario where certain goods, say capital goods, have been written off after they have been completely used in business. A question may arise as to whether, since this capital goods is written off now after being put to use, whether Section 17(5)(h) will come into application. Going merely by the strict interpretation of Section 17(5)(h), there is no doubt that there is a written off which has occurred. The asset has been written off. So therefore, there will be a requirement to reverse the credit. But the question is this the intent of the law, that once a particular product has been completely used in business, it has been used in making taxable outward supplies, is there a requirement then to reverse the entire ITC which has been availed at the time of procurement of this asset. That would defeat the entire purpose, because the logic behind which GST was created itself was to ensure that there is a seamless flow of credit. So therefore, here one may apply again the test of contextualism and understand section 17(5)(h) to only include within its scope those goods which have been written off merely as a result of unintended eventualities, where the goods so happen to be completely worthless and it has to be written off, not in scenarios where they have actually been put to use in the business and used in making taxable supplies. One may take a stand that in this particular question, the answer to it would be that there is no requirement to reverse the credit availed in respect of this asset that has been written off, since it has been used and put to use in making taxable supplies. Similarly, another peculiar situation that may arise is, let us take a case of goods which are sold for residual value after being written off. Now, this is a slightly more difficult situation, because here the goods have been written off, no doubt, but nevertheless it has still been sold for a residual value. So whether is there a requirement to reverse the ITC which has been availed on procurement or manufacturing of this particular good? Here, in my opinion, because section 17(5)(h) specifically includes within its scope written off, one cannot ignore that fact, and one cannot say here, unlike in the concept of goods lost, stolen or destroyed, in case of written off, once the act of writing off has occurred, one would necessarily have to take a stand that there is a requirement to reverse the credit here. And therefore, even though that particular product may be sold for a residual value, still section 17(5)(h) would be applicable in such a scenario. This now brings me towards the third portion of my presentation, which will deal with the disposal of goods as gifts and free samples. Disposal, as we understood, is nothing but to get rid of or to transfer a particular product. But what do we mean by a gift or free sample is a question that arises. Gift, as we understand it, is something which is given willingly to someone without payment. It is something which is voluntarily transferred by one person to another without a compensation. The Transfer of Property Act specifically defines gift. Gift has been defined to mean a transfer of certain existing movable or immovable properties made voluntarily and without consideration by one person called the donor to another called the donee and accepted by or on behalf of the donee. Similarly, free samples can be understood as usually small and packaged portion of merchandise distributed free, especially as an introduction to potential customers. And similarly, a specimen or small amount of a product given free of charge to potential buyers. So this is the understanding of what is a gift and a free sample. But we will take up specific scenarios to understand when and how section 17(5)(h) will apply in respect of these particular situations. The first issue that I take up is, let us take a case where there is certain diaries, pens or mugs which is given as gifts by a manufacturer to his dealers or his vendors. It's nothing but a brand promotion activity to sort of remind him of his brand. So the question that comes up is this a gift which has been disposed of by the manufacturer to the dealer? And is the manufacturer required to reverse the credit availed on these particular diaries and pens, etc., in terms of section 17(5)(h)? Here, in fact, a very similar situation came up before the Honorable Advanced Ruling Authority in this particular state of, in this particular case of Biostat India Limited, where a particular manufacturer was making available gold coins free to his dealers for having achieved a certain target or for having paid or having achieved a certain payment milestone. So the question that came up is can the manufacturer avail credit in respect of these gold coins, or is there a requirement to reverse it in terms of section 17(5)(h)? The manufacturer here tried to argue that these gold coins are not provided free. There is nothing which is actually free in a business. It is all meant to incentivize the dealer or the vendor. So therefore, it is for some consideration and it cannot be called a gift. But the Advanced Ruling Authority in this case, they recognize that this was no doubt a gift which is made available, and therefore the credit would have to be reversed. But here again, from my point of view, these particular products are no doubt meant to incentivize the dealers or vendors and to remind them, or it's a means of brand promotion. So therefore, it can be said that these goods are used in the course of business. On that aspect, there is no doubt. But however, here, the first aspect that I dealt with in section 17(5)(h) has to be kept in mind, that section 17(5)(h) is contained in a non-obstante clause. So therefore, irrespective of whether or not gold coins and diaries and pens are used by the manufacturer in the course of their business, so long as they are provided free of cost, voluntarily, without any compensation to their dealers or vendors, it would qualify as a gift, and therefore credit would necessarily have to be reversed. So now the second situation that I'll take up is a situation where hand sanitizers or thermometers are given to employees. This would be relevant, of course, now in the coronavirus pandemic. And the question that comes up is, are these gifts? And therefore, will a person, the employer in this case, be required to reverse ITC, which has been availed on such sanitizers, masks, and thermometers? Here, in my opinion, this particular items will not qualify as gifts, and therefore there's no requirement to reverse the credit under section 17(5), for the reason that these products are not made available to the employee to grant them any benefit per se. In fact, the intent, it is the intent which has to be seen, and the intent here is only to ensure that the employees are kept safe so that they would be able to perform their duties towards the company, and there would be a continuous, the business will continue without any hindrance. So therefore, in these cases, one can take a stand that there is a mandate on these employees to necessarily provide masks and sanitizers, etc., to their employees. And therefore, one cannot say that these constitute a gift which is made available to employees, and hence 17(5)(h) will not have any applicability. Another important aspect is a question may come up as to whether CSR activities performed by a company, whether that will qualify as a gift, and therefore credit reversals are mandated. One may take up an example where, say, a ventilators, where company purchases ventilators and makes them available to various hospitals as a part of their CSR activity. Now, as we all know, CSR activities are statutory mandate on company to necessarily perform it under the Companies Act. So therefore, a question may arise as to whether these are actually gifts. And in fact, in the erstwhile Senvat credit regime, a very similar issue came up before the case of SL Propack, where certain services were procured and made available as a part of the CSR activities. And the credit was denied on the basis that these particular services had no nexus with the manufacturing activity. So therefore, the credit cannot be availed. It would not qualify as an input service. But in this particular decision, the Honorable Tribunal held that a CSR activity is not a charity, or nor is it a donation. It will assist in only helping the business. It will ensure that stakeholders and all other persons involved in the business fulfill all their requirements, and it helps in increasing the credit rating of the business, etc. So therefore, it is no doubt has a direct nexus with the manufacturing activity, and so credit will be eligible in respect of such CSR activities. But however, here again, the non-obstante clause within which section 17(5)(h) is encompassed is relevant, because since even though the CSR activities, purchasing and providing a ventilator, may be something which is done in the course of a person's business, there is no doubt that these ventilators and goods are made available voluntarily without any compensation. So they will fall within the scope of meaning of gift as generally understood, and credit reversal in terms of section 17(5)(h) may be required in these cases. The last issue which I will consider here is a free foreign trip to dealers. Here, the question may arise as to whether credit reversal is required when foreign trips are provided to dealers free of cost. Here again, the aspect which I had initially dealt with is relevant, because as I had noted, section 17(5)(h) of the CGST Act is applicable only for goods. It is not applicable for services. So therefore, prima facie, one may say that these free foreign trips are only services. They're not movable properties. They're not goods as understood under GST. So therefore, they would not be hit by the restriction under section 17(5)(h) of the CGST Act. However, there is an advanced ruling, the advanced ruling of Surfa Courts India Private Limited, where this very specific issue came up before the Honorable Authority. And they held relying on a circular. I will deal with the circular also below. Circular 92 of 11 of 2019, where there will be a specific sentence in the circular which will merely say that all credits in respect of input service and capital goods, so long as they relate to gifts, will not be available to a particular person. Relying on this particular sentence alone, the Honorable Advance Ruling held that in this particular case, services of making available a trip free of cost, a foreign or a domestic trip free of cost to dealers, will also be hit by the restriction in Section 17(5)(h) of the CGST Act. However, this conclusion appears to be wrong, and because Section 17(5)(h) is applicable only for goods, it is not applicable for services. The next issue that I will take up is in a situation where goods are supplied to a customer under warranty. A question may come up as to whether is there a requirement on the manufacturer or on the person who's providing these warranty services to reverse ITC availed on the goods which have been procured. Here, it is relevant to note that a warranty contract, those goods which are made available under the warranty contract, one cannot say that this is provided as a gift or it is free of cost, because the price of these goods or the price of actually providing the warranty is inbuilt in the price that is originally agreed by the manufacturer and their dealer or customer. So therefore, one cannot say that those activities that are performed in the course of warranty is something that is performed free of cost. These price of the goods have been inbuilt into the cost of the vehicle or any other particular item which was initially sold. So therefore, this Section 17(5)(h) of the CGST Act will have no applicability to goods provided under a warranty contract. The next issue which I will consider is goods that are sent for testing at a customer site, whether this will qualify as a free sample. Here, we can take up a scenario where an example of maybe a tea manufacturer may send a small sample of his tea for testing at a customer site. So a question may come up as to whether this is a free sample that is provided, and therefore ITC would have to be reversed in respect of that tea which has been manufactured. Now, here one may again take the stand that this testing is a necessary part and parcel of the business. It would not be possible to make sales or to undertake their activities without allowing their customers to test and understand their particular products. So therefore, there is no requirement per se to reverse the credits, because you cannot call this a free sample. It is an inherent part of their contract. But however, going by the general understanding of what a free sample is, no doubt that a specimen that is provided to a customer to merely undertake testing can qualify as a free sample. So therefore, there would be a requirement to reverse credits in respect of these samples. And the last issue which I will take up is these buy one, get one free offers. Say for instance, where a customer purchases 10 kgs of rice, they may get 1 kg of sugar free. So question may come up as to whether ITC is required to be reversed in respect of the sugar that has been provided free because it is a gift or a free sample. Here, this very same issue came up before the Honorable Advance Ruling Authority in the case of Moksha Agarbatti Company. In this case, the applicant was a manufacturer of agarbatti. He floated various incentive schemes. For instance, he provided 1 unit of dhoop free with a pack of agarbatti. He also offered some non-monetary incentives like a pressure cooker for having purchased a certain item of agarbatti and 1 box of agarbatti for 1 carton of agarbatti, etc. So they the applicant approached the Advanced Ruling Authority seeking a clarification on whether ITC would have to be reversed in respect of these goods which have been provided free along with the other items. In this case, the Honorable Authority held that ITC would have to be reversed because of Section 17(5)(h) of the CGST Act, and that these goods are provided free of cost as a gift, and therefore credit reversal is mandated. However, there is a circular. This is the circular which I was also referring to earlier, Circular 92 of 11 of 2019. This mentions the contrary in case of 1+1 offers. In fact, it states that I will read out that specific portion. It states, it may appear at first glance that in case of offers like buy one, get one free, one item is being supplied free of cost without any consideration. In fact, it is not an individual supply of free goods, but a case of 2 or more individual supplies where a single price is being charged for the entire supply. It can at best be treated as supplying 2 goods for the price of 1, and therefore it clarifies that ITC will be available. So the circular clearly takes into account marketing strategies, and it understands that there is nothing free in a business. So therefore, even though one may advertise these particular products as a buy one, get one free, it is not as though the product which is considered to be provided free is in fact free. It is nothing but included within the price that is agreed for the entire package. So therefore, there is no requirement to reverse the credit. This, in my view, is the correct stand as regards these buy one, get one free offers. This brings me towards the last portion of my presentation, where I will deal with the interplay between Schedule 1 of the CGST Act and Section 17(5)(h) of the CGST Act. Schedule 1 of the CGST Act lays down certain specific transactions in respect of which tax would necessarily have to be paid, even if these particular, especially and when these particular transactions are undertaken without a consideration. What is covered within its scope is a permanent transfer or disposal of a business asset where input tax credit has been availed on such asset, and supply of goods or services or both between related persons or between distinct persons when made in the course of furtherance of business. So therefore, if there is a permanent transfer of a business asset on which credit has been taken for without a consideration to any person, then there is an outward taxable supply which is rendered on which tax would have to be paid. Similarly, when certain goods are provided without any consideration to a related party or to a distinct person under GST, then also there is a requirement to pay the tax on those particular goods and services, because it is deemed to be a supply, taxable supply, in terms of Schedule 1 of the CGST Act. Now, the question that arises here is that, is there a conflict between the operation of Schedule 1 of the CGST Act and Section 17(5)(h) of the CGST Act? Schedule 1 of the CGST Act, although it requires them to pay GST on the output supplies, is there also a requirement to reverse the ITC which has been availed in respect of these goods which are permanently disposed of, or in respect of those goods which are made available to a related party? Say for instance, a sample which is provided by one related party to another free of cost. There is no doubt that this particular product will, with this particular transaction, will qualify as a supply in terms of Schedule 1 of the CGST Act, and tax will have to be paid on the output end. But the question is, will this also be said to be a goods which has been disposed of in the form of a free sample, and therefore Section 17(5)(h) will also operate? So is there a requirement for tax to be paid on the output end, but also to reverse the credit on the input end? And this, if this interpretation is accorded, of course, it will be a double whammy for such persons who are engaged in providing Schedule 1 supplies and who also fall within the scope of Section 17(5)(h). And in order to harmonize this situation, this same circular which I was referring to earlier, it also clarified on this particular aspect. It stated that where the activity of distribution of gifts or free samples falls within the scope of supply on account of the provisions contained in Schedule 1 of the CGST Act, the supplier would be eligible to avail ITC. So therefore, this particular circular clearly clarified that so long as tax has been paid on the output end, and if these goods fall within the scope of Schedule 1, then there would be no requirement to reverse the credit as well because of Section 17(5)(h). So with this, it brings me to the end of my presentation. And my intent through this particular presentation was only not to place before you the various, the correct interpretation of the law. It was only to create a dialogue or to raise certain questions on the various interpretations that is possible when it comes when we have to interpret Section 17(5)(h) of the CGST Act. And I hope that I have been able to throw some light on the various scenarios that could arise in business and how this particular provision can be harmonized. In my opinion, as a concluding remark, I would like to state that the approach that has to be adopted while interpreting Section 17(5)(h) of the CGST Act is a more contextualist approach that I had mentioned earlier, wherein the law, Section 17(5)(h) of the CGST Act would, the intent of the law would also be given regard to while taking into account the business realities as well. With this, I come to the end of my presentation. Thank you all for your patient listening. And if there is any questions, I will take it up at this time.
Thank you, Sahana. It was indeed a very wonderful and a lucid presentation, as we've already been seeing in the chat box, the various comments coming up.
Thank you,
So
Prithvi.
to all the participants, now we can have the discussion round where you can supplement to the presentation what Sahana has given us, or if you have any queries, also uh, you can you can you can raise your queries by raising your hands in the app, or you can put it in the chat box. Sahana, in the meantime, we can close the slides.
Yeah, I'll do it.
I see a couple of messages by Gokar Nation sir in the chat box, Sahana, if you can.
Okay.
I'll also unmute him so that he can ask the question.
Yeah.
Gokar Nation sir. Gokar Nation sir.
Yes, yes, yes. 1 minute, 1 minute. Okay.
Yeah.
One minute, 1 minute, 1 minute.
Yes, sir. Yes.
See, hello.
Yes, sir.
Yes, sir.
See, I have received a goods which is kept for more than 5 years. I have not used the goods, so I return off fully, charge it off to revenue account, and I have reversed the credit also. Now I fulfill the obligations under the GST provisions. Now the question is, subsequently I am using the input in the manufacture of another product on which I pay full GST. Now the question is, how will I recredit the good ITC already reversed, or is there any provision to claim refund if there is no provision available for recredit? The question is, once written off, subsequently if the input is used, can I take the credit? Because this provision was available earlier under the General Credit Provision Rule 3.5. Now, whether a similar provision is available in GST Act?
Sir, there is no specific provision under the GST Act for recredit. So, but there are two things here. One is because this particular input, as I was saying in your comments, is purchased in prior to GST.
No. It is after GST only. I'm telling you.
Okay. If it is after GST, then if credit has been availed on this particular product, then of course there is a requirement to write off. But there is no specific provision for under the law which will permit for recrediting of this particular credit.
See, the question is, this was available under the earlier provisions of General Credit Rules, which has been denied under the new GST provisions, right? Am I right? The assessee is put into
Yes, sir. Per se, there is no specific legal provision. So yes, to that extent, the law is silent on that point.
Okay, we have to test on the floor, number one. Now, the second question is, see, as per the IT provisions, when a input is written off in the books of accounts, I have to return off for the value of the cost of product or the net realization value, and whichever is lower only. Now, I fulfill the income tax conditions. I take the lower value, which is a net realization value is 100 rupees, cost is 500 rupees. So I reverse the 100 rupees in the income tax books of accounts for the purpose of income tax provisions. Now, what treatment I have to give it in GST? Whether I have to reverse for 100 rupees or for 500 rupees?
Sir, can you just repeat your question, sir? I didn't follow entirely.
No, my point is, I purchased input which is kept in stock without usage. My auditor says you have to reverse the credit. You have to return off the credit, write off the credit, write off the value of the input as per the income tax provisions. Okay. Now the income tax provision says you have to return off the value which is cost of the input or the net realization value, whichever is lower. Now there is a two scenario. My cost is 500 rupees. My NRV value is 100 rupees. So I reverse 100 rupees in the books of accounts for income tax purpose. For GST purpose, whether I can reverse the GST on 100 rupees or for 500 rupees, that is my question.
Sir, in my opinion, the reversal will have to be for 500 rupees because there is no concept of partial reversal or anything of that sort under GST. So therefore, for the entire cost of the product. Since
So
it is
there is,
500 in your case, credit would have to be reversed to the entire extent.
in other words, you want to say this, the income tax provision has nothing to do with the GST, and whatever the credit taken, it has to be reversed. That's
Yes,
correct?
sir. Yes, yes, sir.
Thank you, thank you, thank you very much.
Uh, can I request Joseph sir to kindly clarify on this point also, sir? Joseph sir, your views on this?
Yes, whether there was provision, sir. Mr. Gokarthnesen says, yeah, under
Yes.
the S12 Senvat credit, there was a provision to take recredit. Is that so, sir?
No, absolutely right. Actually, I don't know whether the recording is still going on. I just wanted to.
Yes, the recording is going on. Yes.
I don't know whether I can probably say something in Tamil.
Hey, yes.
You can, sir.
I'm reminded of some movie in Karagatakaran where there's a car which is used by Ramarajan. He will say, இதுக்கு வந்து பெட்ரோல் ஊத்தியாச்சு, அதுக்கப்புறம் டீசல் ஊத்தியாச்சு, இப்போ அதுக்கப்புறம் என்ன ஊத்திட்டோம், இப்போ எதுல ஓடுதுன்னு அதுக்கும் தெரியல எங்களுக்கும் தெரியல மாதிரி. The problem is it is amalgam of the S12 central excise law and the state VAT laws. Whatever input tax credit provisions which are there, which were and in the central excise, both have been actually amalgamated. So now neither the department knows how to interpret, nor the assessee knows. That's a problem. If you see any of the provisions, they have not adopted the central excise in verbatim, nor they have adopted section 19 or whatever in verbatim. They have actually mixed, because both center and state were involved. It is a complete mix, so it gives rise to a lot of ambiguities. That's the first thing. As far as Mr. Gokarthnsen's query is concerned, the reversal should be on 500, because it has nothing to do with income tax at all.
That's correct.
I am saying even central excise or VAT provisions or the interpretations therein will not hold good. So where is the question of income tax coming into play at all? In fact, the GST has been, GST was born with the demise of excise and VAT, getting into taking all the provisions, and that itself is not going to apply. If you probably remember the recent, I think Sahana was referring to GBR metals. That is just a Saravanan decision, no?
So that I'm not very sure. I'll just.
It's a final order, no? It's not an interim order.
Yes, sir. Yes, sir. That is the final order.
GBR metals is the final order. Actually, that order is under VAT.
Yes, it's under the TN VAT Act, sir.
Tamil Nadu Value Added Tax Act 2006. The same GBR metals I have actually appeared. There's a stay granted by Justice Anita Sumant, the GST under Section 17(5)(h). For that also, the department is taking a stand that the erstwhile interpretation of write-off, stolen, lost, all of that will not apply, because the provision or the section is not parimetry. It is not exactly the same as what was there under VAT. You can't strictly apply. You have to go by case to case, whether the same wordings are carried over or probably into this. Yes, thanks, sir.
Thank you, JP sir. While we are dealing with invisible loss under VAT, I would request Rajasekhar sir, if he is available, to kindly throw some light on invisible loss under VAT also.
Rashid appeared, and I think there's a batch.
Yes, he did many cases on invisible loss.
Invisible loss. Now he is invisible now.
Hello, he must be there.
He is here. I'm just unmuting him. Rajasekhar sir, you can kindly unmute, sir. Yes, sir. Rajasekhar sir, your views on invisible loss.
All big stalwarts are here. Why do you people mind?
One more stalwart, sir.
You are also one of the stalwarts.
Gautam Prabhakar, Vishwanathan sir, all these people are there. Invisible loss was basically with respect to the question was in that case, which I was dealing, was an iron and steel manufacturer, just like what the speaker has just now mentioned in her example of an iron and steel dealer. But there were two options in it which projected over there. There was a case where the raw materials which are put into production, and in the course of production there was a residue which she calls, which is also called a slag in that industry. That slag was either resold outside in the market as such for a price, or the slag was again used as a raw material from round one into the production. It was also used put inside. So the option available to the assessee was he was taking a stand that this slag has not become a waste totally. I am reusing it. One option. The second aspect that he was saying is I always took care of the price component, including this wastage. So where is the question of reversal on that? So whether it would strictly qualify under 1993. After the invisible laws of Justice Srinivasan's view, Justice Saravanan had a different take on that. He was not in full agreement with Justice Srinivasan's view. So adding like a rider in the end of the judgment, he just quoted the judgment which the speaker quoted right now, and he said manufacturing losses may not strictly fall under the concept of loss per se. He said it has to be taken into consideration for the purpose of manufacture. But he added that rider and he remanded it back. So as of now, the cases have been thrown, the ball has been thrown back to the court of the officers. Now they are in a jeopardy. They do not know. They are in a quandrum actually, whether to apply Justice Srinivasan's order or to go by the last rider paragraph of Justice Saravanan. I am told that there it stands as such. This is the present position in invisible laws that I have dealt with. That's all I have to take on this. Nothing more to add.
Thank you, sir. Now I would call upon Mr. V.S. Jayakumar, sir. He had raised his hand. Jayakumar, sir.
Hello.
Jayakumar, sir. Yes, sir.
Oh yeah, Sahana, you did a fantastic job.
Thank you, sir.
And see, I have only two small doubts. I am a novice in this branch of law. See, you said for the title itself as goods. Will it apply to semi-finished goods?
Yes, sir. The goods definition under GST will encompass all kinds of movable properties.
Oh,
So therefore,
excellent.
17(5) should cover every kind of good.
Okay, if this logic is correct, when it came to write-off, you said total write-off.
Mhm.
So partial write-off is also in the General Clauses Act. Once there is a particular word, whole includes part. Whereas you went by the dictionary meaning. And of course, some tribal decisions in VAT and other places. So I would request you to appreciate General Clauses Act is the guiding force to interpret every law under the sun. If semi-finished products is included in goods, so also the write-off, partial write-off can be included is my throwing out the idea to the public.
I think.
Thank you very much. You did a good job. I've complimented you to your senior also.
Thank you, sir. Thank you. Hello.
Yeah.
Yeah, sir, on that point which you were mentioning, but I think the test that is applied qua goods and what is applied to the term written off, I don't think the very same test can be applied because goods is a specific term that is defined under GST. So therefore, that definition would necessarily have to be borrowed. But when it comes to written off, because it is contained within the scope of a specific provision, and we are interpreting that provision, first the rules of interpretation would have to be applied, and applying the construction of Nositra society on that basis, I said that the term written off will not include within its scope. One view which I said is possible is the term written off will not include partial write-off or a provision to write off. But of course, what you're saying, sir, that particular test is also, it can be applied, which is why I had said that there is no one view which is possible. So it is possible to say that write-off will include all of these aspects, but I think because of applying the rule of construction, the very same test which would be applied to what is covered within goods cannot be extended to the words which is contained within a clause in the Act of Parliament.
Excellent. Thank you very much. Thank you very much.
Prithvi, just to add on to what Sahana said, Natarajan here, not only that view, you can also support the view by going to the Senvan credit provisions. If you see the earlier Senvan credit provisions, earlier the requirement was only for a write-off. Subsequently, they amended whether the value of the inputs are written off wholly or partially. So they made a specific amendment in the Senvan credit rules where the reversal will come even if it is partially reversed. But when it comes to GST 17(5), it doesn't talk about any wholly or partly. So it should apply only to complete write-off and not for partial write-off. That is one thing. Second, I just want to hear your views. I don't know, I'm not sure whether you have touched this. If I have purchased some inputs, they are lost, they are destroyed, I am liable to reverse the credit, no doubt. If I think somebody has raised this question also in the chat box. Suppose if I am a manufacturer, my manufactured product is destroyed or lost, or its a useful shelf life has gone. So whether I will be required to reverse the inputs contained in the final product, which is lost or which is destroyed. What is your view on that, Sahana?
Yes, sir. In my view, even if it is a manufactured product, so long as that particular product has been lost or destroyed or stolen because of unintended eventualities, not as a result of something which they would have foreseen, then to that extent, the credit in respect of inputs which have been used in manufacturing that product would also have to be reversed. I think that logic would have to be extended as we interpret Section 17(5)(h) of the CGST Act. Because of the term in respect of, the term which is used is in respect of the goods, that is very wide in its ambit. So therefore that will cover even inputs which are used in a manufactured good.
Okay. Thank you.
Hello.
Yes, sir.
Sir, I am Gokarnation again here. I want to add some value addition on the issue of the slag, which is referred by Mr. Rajashekar and Advocate sir. Now, the slag is being sold to another customer for using as a fuel on payment of GST, or if it is consumed captively as a fuel in the manufacture of other use in the boiler, all these things. So naturally, they have to pay GST when it is cleared outside on payment of tax. The question of reversal does not arise because treating this as an exempted product or a scrap or destroyed product, all these things. Secondly, if it is for captive consumption, naturally it goes along with the final product. So the question of reversal does not, maybe the case law refers to maybe the sales tax period prior to GST. But under GST, the slag is cleared on payment of appropriate GST, the other person is taking credit. So the question of reversal does not arise. Correct, sir? Natarajan, sir, am I correct? Hello.
Yeah. Yes, sir.
That I want to add as a clarification, sir. Nothing.
Right, sir. It's the character of a byproduct. Maybe not strictly as a byproduct, but any product which is cleared and free from that, it doesn't become something which is removed without payment of duty. It suffers duty. So therefore, the reversal simply will not arise.
That situation arose under the VAT Act, where the authorities were taking a view that once it goes out as a waste residue, you are liable to reverse credit, notwithstanding the fact that it is being re-engineered, put back inside the manufacturing process.
No, re-engineering may not be the criterion, whether it is tax paid or not.
No, that was the opinion of the authorities at that point of assessment. So on that question only, the assessments came to be passed and it was challenged. So I was just mentioning about the scenario with respect to VAT, not with specific reference to GST.
Thank you.
But the view seems to be that, at least the current view of the High Court, Madras High Court, seems to be that any input is the process of manufacture. That is, if you take the goods, inputs are received into the factory and then issued to the shop floor for manufacture. Once it is issued and it undergoes the process of manufacture, whether 10%, 20%, whether it's capable of being called a semi-finished or whatever, or defective finished goods. The moment it is put into the process of manufacture, and thereafter there is a need to remove that as or something like that, then reversal may not apply. Seems to be the current thinking. Of course, it's not the GST law.
Exactly, sir. There are some inevitable losses, like she mentioned, evaporation losses. Industries have got evaporation losses. So those things are.
Evaporation is clearly not requiring reversal of tax credit.
Thank you, sir. I see a couple of messages from iPad. I don't know who is it, but the message reads as there is a Supreme Court judgment which was held that in respect of would mean in respect of the same good. So section 17(5)(h) may not apply on loss of raw materials. Section 17(5)(h) can be said to apply only in respect of loss, etc., of goods on which ITC has been availed, rather than on account of loss of raw materials used for manufacturing the good itself. Thank you. Vishwanathan sir,
Yes,
sir, if you had to supplement on any point, sir.
yes. First of all, my compliment to Sahana. It may look that it is a very simple subject, lost, destroyed and all that. And it's only one provision, we could cover it up. It has a lot of implications and especially as Joseph has said, after VAT and central excise manufacture merged, there's a lot of concept to be taken from various provisions for the interpretation of the statute. What I basically find from this discussion here is they have used the term business activity instead of manufacture, which covers both trading and manufacture. They have said business activity. So if I am using it in a manufacturing business, that satisfies the requirement of earning that credit for that particular item. And you will also find that 17(5)(h) and all that use the term goods. They never use the term input to say that input has to be reversed. They are not referring to that. Therefore, what she said was absolutely right, that it is not meaning what is getting lost in the process of manufacture. It is by accidental process where you are not able to sell that goods or supply that goods which gets lost or destroyed. After being manufactured, at that stage only, according to me, 17(h)(I) or 1 will apply, not before that. So in the course of manufacture, according to me, the law protects the credit. It does not defy you that credit. That is point number one. As far as Gokarnasan's question, I feel, it is my personal view, you need not go into the valuation, because what is denied is the credit that you have taken. You are not entitled to the input credit. Means you don't, supposing the value appreciates also, you don't have to rework the reassess the credit limit on that basis of that value. What you need to reverse is what you have taken. That is all the simple meaning of that provision. And therefore, these things have to be settled by the judgments in future. I don't think the earlier judgments could be straight away telescoped, and interpretation is not possible in this. The law has to settle in GST because it's a mixture of VAT and manufacturing. So it will have to be seen with reference to a particular registered person, and the facts in each case will have to be gone through. Anyway, my congratulations to Sahana. She did a very wonderful job. It's not an ordinary subject, and her very lucid lecture was very good. Thank you, appreciate it. Wish you all the best.
Thank you, sir.
Any adverse view on my point also I am welcome, because one more thing I wanted to say about Rajsekhar. Rajsekhar named me, but I rate him one of the very top advocate with highest knowledge. As I have seen him in the High Court, my open, honest meaning. Rajsekhar don't have to feel like that at all.
Sir, I fully endorse your views, sir. Mr. Vishal,
Yes.
sir, whatever you said is absolutely right.
Yes.
No, not about Rajsekhar.
No, he is one person who goes into the law and argues the point. I have to admit that I have great respect for him.
About the presentation and about the input tax credit on the reversal conditions under 17(5)(h).
And one more thing about that slag, what we are talking, maybe in the VAT provision, slag was not an item listed for tax. But now under the GST, any supply of any goods or service is brought in now. So there is no question of non-payment of tax on the final product. I'm not very sure about that VAT provision, whether slag per se was treated as a commercial commodity and listed in the schedule for a tax.
No, sir. We already had the residuary category, sir. Goods is not listed anywhere else. So there's no.
That I'm not aware of. But if he is going to assess the slag for a tax, then he is right to claim that reversal is not there.
This is not like central excise. You can always have a residuary entry.
Yes. Acharya, any comment on that? Like,
I'll mute him again. He has muted.
and first question of cognition also, I can't resist saying, he has put, he himself has said we have written off, then he himself want to reverse. These kinds of commercial activities, I don't think any commercial concern can adopt to take it. Once you have decided to write off, where is the question of reuse of the material? Then what did you do with your income tax return? How did you take it back? Did you take it to your income tax return back? All that question arises. And definitely that's not a question for Sahana.
Probably mixed up with the liberty to refile again.
Yes, that and all has to be done before claiming you are right.
Thank you, sir. Thank you very much for this wonderful discussion by JP sir, Vishwanathan sir, Rajshekhar sir, Gokul sir, APS sir, Natarajan sir also. I call upon Joseph sir for kindly tell the closing remarks, and after this we will end the.
One more thing before closing, whenever you ask any youngster to appear and present themselves, you must make them comfortable. Don't have this question answered directly. Let it be a general discussion. That is my suggestion. I may be wrong. Please bear with me for that.
No, sir, that is not, I mean, there's no question of young, old and all that, sir. No.
No. You may put them in anywhere, but my suggestion is that you.
Job. And the topic, of course, was very interesting. And I would say that she has done it in a very strong, taking part A, part B, part 3 with dealing that a sample and gifts separately. In fact, if you see 17 for H, the first 3 limbs like destruction and lost and written off will have nothing to do with the second limb. In fact, this should have been a separate subclass actually. It should have been 17 for H. Maybe the second one should have dealt free sample and the gifts actually. Because in free sample and gift, there's no destruction, there's no physical going away. It is actually given. So the first limb itself, by mixing all this itself, is creating a lot of trouble. So with all that, you know, the presentation was very good in giving a part by part interpretation. So excellent show, Sahana. Congratulations.
Thank you, sir. Thank you
Thank
very
you.
much.
Thank you very much, Joseph sir. And thank you once again, Sahana, for this wonderful presentation,
Thank you,
as
Guru.
Joseph sir has rightly put up. And thanks to all the participants for joining us today. We will be uploading the session on our YouTube channel very soon. So thank you once again. Kindly stay safe, take care of yourself and your family, and have a good day. Thank you.
Thank you.